Biggest reason traders fail, blow up, and miss their payouts is because of what I'm going to be sharing with you today. That is the 8 deadly emotions in trading. As I've started to speak to some of the best traders in the world on my podcast over the last 3 years, I'm talking trading psychologists, authors of trading psychology books, and some of the best trading minds in the world. I've started to understand psychology in trading goes a lot deeper, because it's important to understand there is a fine line, a balance between a lot of traders using psychology as a scapegoat because they don't have an edge, they don't have a strategy, they don't have a system, they don't really know what they're doing in the markets, but it's way easier to blame your psychology and say it's just fear and greed. But on the other side of the fence, the reality is that once you have a trading system and true edge, your trading psychology can actually be detrimental towards adhering to the plan, maximizing the plan, and most importantly, the reasons you blow up, burn out, and go on tilt. So in this episode, I'm going to be walking you through all 8 of the deadly trading emotions, and most importantly, I'm going to be citing multiple authors, multiple books, and multiple sources of literature so that not only can you see what some of the best traders on my podcast have said, but some of the best traders across the world, alive or dead. And my goal is not just to share with you some self-help fluff that is going to make you feel good. Rather, I want to make it actionable advice so that you can actually walk away from today's episode with a plan of action, so that when you feel a certain emotion, you know exactly why it's there, what it's telling you, and what you should do about it. So with that being said, let's jump right in and understand deeply each one of these 8 deadly trading emotions. So before we do a real deep dive into all of these emotions that we have on the screen, what I actually encourage you to do is download this resource. It's absolutely for free, and fill out this self-assessment. There are certain questions in here that will be deeply understanding your triggers, your traumas, and what makes you tick, what brings out the bad side of you, the bad emotions out of you, based on the amplifier that the market is. All of these questions, if you can answer them as honestly as possible, and then once you've done this and you're just clicking yes or no, it's very easy, it'll literally take you a couple minutes, and then you reveal the result. When you reveal the result, you'll get a personalized score on what you are dominant, which emotional patterns are dominant for you. So based on this random answers that I just gave it's telling me the emotion that I need to pay most attention to based on those answers is actually revenge, and then shortly after that anger, and then a little bit after that desperation. So therefore, if I know that these 4 are my most pain points, these are going to be my most problematic emotions, then I know in this video what I need to focus on. And then after the video, even what you need to deeply understand and put protocols in place to manage these emotions. Okay, so let's get into it. Most traders lose not because they lack a strategy, but because they cannot execute under pressure. The market doesn't break your system, your emotions do. So based on all of these authors and certain people that I've had conversations with on my podcast, this is the definitive map of 8 emotional states that destroy trading performances and precisely how to address each one of them. Now, addressing each one of them doesn't mean you need to meditate and journal your thoughts away. Sometimes it's as simple as having a protocol in place. For example, back in the days when I was a doctor, when we would have certain episodes in the clinic, for example, anaphylactic shock or an epileptic fit, or for example, someone passes out, you wouldn't actually have to think of what to do in the moment. Because in the moment when someone's life is on the line or there's a medical emergency, emotions are high, maybe people around you are panicking, maybe you have a time constraint, and all of these stresses can naturally lead to wrong decision making and not following the logical things you may have studied at university. So instead of actually relying on your memory and decision making in the moment, what we do as medical practitioners is have a protocol in place so that each one of these emergencies that can arise, we already had memorized step by step exactly what to do. So there is a predefined protocol for a medical response for each medical emergency. So similar to all of these emotions, it's not about in the face of adversity of each one of these emotions, you have to logic your way out of it or meditate your way out of it. It's sometimes as simple as having a specific protocol to resolve it. So let's further elaborate on why your edge is not the problem, your psychology could be. Because study after study confirms what experienced traders already know, that the majority of retail trading losses are not caused by faulty strategies. They are caused by inability to execute on a working strategy. This is known as adherence. Now, adherence to your plan can be performance related or it can be psychologically related. Performance is going to be your external environment. Are you tired? Are you sleep deprived? Are you having relationship problems with your wife? These are going to be external stresses. And then you're also going to have internal stresses amplified by the markets. These emotions that we have, these 8, are not related to your external life. It's related to amplifiers that the market brings out. The market brings out these emotions. Your trading system brings out these trading emotions. And therefore, you need to know these internal, intrinsic emotions and how to deal with them. So just citing some studies, 80% of retail traders cite that emotional decisions as the primary loss driver. Most traders cite that the reason they take losses is because of their psychology. Now that might be skewed because people blame things and scapegoat things towards psychology, but nonetheless, it is apparent that this is something important to address. And then this idea of loss aversion ratio. Usually the ratio is 2.5x, meaning you feel losses 2.5 times worse than the equivalent gains feel good. So therefore, the positive feelings of a winning trade is not a 1-to-1 ratio with the equivalent amount of loss. So imagine I offer you to flip a coin right now. Lose, you pay me $100 from your wallet. Win, I pay you $150. Most people say no to this bet because they don't want to lose that $100, because even though it's a 50-50, they can win more than they would lose, but they don't want to take that bet. That feeling is loss aversion and is running in the background every single trade you take. And therefore, if you win $500 in a trade, but for your mind and psychology to recover from a $500 loss, you actually need to make 2.5 times greater, which means you need to make $1,250 just to feel at peace with that one single loss. Which is why it's important to have a positive risk-reward ratio in your trading, not just because it makes your life easier in the markets, but because it helps your trading psychology. And it's important to realize all of these emotions exist in every single one of us, but importantly, none of these emotions are permanent and they are avoidable, and most importantly, all can be managed, which is the goal of today. So first off, we have greed. And greed is something I'm sure you are all familiar with. Why? Because it stems with the identity of a trader. The reason we all became traders is because it's a non-conformist path. No one starts out at 18-year-old thinking, I want to go to become a trader. You will start off thinking, what career can I do? I maybe go to university, what job I can get. And then as life goes on, you deviate away from the roadmap in front of you and you become a non-conformist. But to be honest, when most people start a career or go to university, the primary reason is not necessarily money. But with trading, the only reason we become a trader is because we want to better our financial situation. It's not because we have a skill for it. It's not because we are particularly attracted to it. It's not because it's something that is particularly interesting. It's outcome orientated. So therefore, greed is going to be an embedded emotion in all of us, because the reason we entered the arena of trading, which can be very easily linked to the word greed. And greed can sound like in the voice in your head that this trade is working, I'll just leave it a bit longer. Greed is the impulse to extract more than your plan specified. It feels like patience, it feels like conviction, it feels like confidence or overconfidence in certain scenarios when it comes to ego, but it's a quiet removal of your risk parameters in real time and almost always leads you to giving back profits that you shouldn't have. Okay, so where does greed come from? In our animalistic brain, or in general in our brain, greed emerges from the brain's mesolimbic reward system, the same pathway that is linked to dopamine, which often dopamine is a neurotransmitter for your reward, which is therefore tied to motivation. Because when you go out to hunt, when you go through hardship to hunt an animal, when you finally catch the animal, you release dopamine. It's a reward mechanism to go out and do hard things. And that same pathway governs addiction, because when you have low barrier or cheap ways to access dopamine, your body cannot tell the difference between dopamine that is released by going through something hard, that is actually success or achievement, versus just scrolling on your phone or accessing cheap dopamine through food and other types of addictions. And when a trade moves in your favor, dopamine release is not proportional to the current gain. It is proportional to the anticipated future gain, meaning the dopamine released when you're in profit is not as powerful as the dopamine being released right now for the calculations you are projecting on what you could make. Therefore, greed is directly tied towards dopamine being released. And dopamine itself is designed to be a motivator. It's a neurotransmitter to make you go through hardship to achieve something. So if your dopamine is heightened when you see you could make more money potentially, then you are motivated to do that. And therefore, the neurotransmitter that is hardwired, dopamine, is actually fighting against you because your greed is taking over you here. And therefore, the brain perpetually discounts what you've already have and amplifies what you might have. And in trading, greed specifically manifests as a target removal, meaning refusing to close a trade even though it's reached your objective because you could let it run further. And then you have these sound bites that you hear online, for example, let your winners run, or it's all about risk to reward, and the voices in your head, out of context, make you feel like you're doing the right thing because it feels like you're being patient, you're being disciplined, and you're actually following the plan that you made up on the spot. But it's actually powered by this greed system in your brain. But next we can move on to is the psychological countermeasures. Exactly what we can do to address these emotions. So first is going to be reframe, next is going to be ritual, then it's going to be anchor, and then it's audit. So reframe is process over outcome. A trade that has hit your targets, you follow the process, you know that I have to be disciplined, which is why I always say a restricted trader is a profitable trader. Your plan is king, because even though deviating away from the plan might lead to a short-term beneficial outcome, over the long term, it will always lead to less favorable outcomes because it's not factored in and it becomes just a roll of the dice. Sometimes it may go in your favor. A lot of the times, acting upon your greed will not go in your favor, and therefore over time, you deviate away from the plan and you end up worsening your situation, even though it feels like in the moment you are bettering your situation. So remembering the plan is going to be king. Number two is going to be ritual. Close the chart immediately. For example, certain things that I will do is have blockers in place. There are certain technologies. You can cut off your MetaTrader, you can cut off your trading view based on targets that you put in, or as simple as close your laptop, because that feeling is intense as you're watching the P&L, as you're watching the charts. But as soon as you close your laptop and go for a walk, within seconds, the feeling does simmer down and you enter a sense of respite away from that emotion. So just having a protocol, a short momentary decision making of walk away right now. And the moment you've done it, you won't really have a strong reason to go back. Then now the next thing is having a physical anchor. Now, a lot of traders have a plan that I'm going to take profit at this level, but what I've spoken to certain traders do, they'll have casino chips in their hands, or they'll have other physical things that they can touch that's going to trigger them to actually place the closing of the trade. So therefore, it's not just something that's held in your mind. It can be something that is technologically based, or it can be something like chips. So as you enter different risk reward profiles, 1 to 1, you move a chip, 1 to 2, you move a chip, and 1 to 3, that last chip, when you've placed that chip down, you ran out of chips, then that becomes a nice physical cue. And certain traders have told me this helps them a lot. And then the last thing is audit, is track all the trades where you moved your take profits, because data is going to remind you next time when you moved away from the plan, it didn't actually serve you, because over time, sometimes you moved your take profit level and you actually made more money. And that's the worst thing that can happen when you make a wrong decision and leads to a positive outcome. It becomes a positive feedback loop that you don't want. So when you audit your decision making and you see all of these times I deviated away from the plan, despite sometimes it worked out, most of the time it didn't. So when you know this in the back of your mind, you have the confidence of your data. In the moment you feel greed, next time you remember the data behind you and you realize deviating away from the plan sometimes serves me, but overall will not. And therefore you'll be more at peace with not acting on this emotion. And the last part is catch it before it costs you, which is going to be knowing the amplifiers. And this feeling of greed is going to be heightened when you are on a winning streak. After consecutive wins, you build a bias, you build a sense of being overzealous, overconfident. You're on a winning streak. You think you've actually got a better level of skill because you're on flow state. In other arenas, for example, if you're playing basketball, you're actually on form. That doesn't apply to probabilistic scenarios in the markets. So understanding on a winning streak, greed will be amplified. Understand greed will be amplified if your position is too small. For example, if you always do 1% risk and then you lowered or modified your risk, even though you made amount of money, it's not what you're used to. And therefore dynamic sizing can actually be detrimental, both in winning periods and losing periods, which is why I specifically use standardized risk. If I always risk 1%, my losses, I know exactly what it should feel like. My wins, I know exactly what it should feel like. And then I don't have a sense of greed because I don't have the same amount that I'm used to. The next is going to be social media. If you're going through a losing period, and you see everyone on a Discord, everyone on Instagram, everyone on YouTube showing wins after wins after wins, naturally that's going to be amplifying the emotion that I'm not good enough, I'm not doing something right, and then it's going to encourage you to just go YOLO, to add more size, go more crazy, trades that you shouldn't be taking. This is all a remnant of greed. And then lastly is financial pressure. So if you have bills to pay, if you have financial stress on your shoulders, naturally, you're going to be like a gambler going again to the roulette wheel, trying it one more time. You're just placing more trades to better your immediate financial situation. And in those cases, the best way you can resolve your financial situation is not the markets. You should have another job, a stable income. Look to solve your financial stresses first, because that's going to be a psychological anchor that is weighing you down in the markets. That is pressure you don't need, because it's actually going to lead to making worse decisions in your trading. By the way, if you want to better understand how you can structure your emotions towards your technicals, not only just the protocols to have in place to subside or better regulate these emotions, but rather building a technical strategy, your strategy on the charts, the type of trades you take, the trade duration, how you manage and modulate risk, all of these components can be personally addressed inside of WWA Trading, where we have one-on-one coaching, where you'll sit down with your one-on-one coach and they'll better deeply understand your psychology, your goals, and what temperament you have, what personality type you have, and then build a strategy around that. So that is not a one-size-fits-all, because how can a strategy be a one-size-fits-all when everybody's personality and goals are different? So that's why inside of WWA, we have a whole ecosystem which is empowered by AI. We're talking AI journaling, AI software, AI charts, everything is AI powered and connected. So therefore your journey and progress is tracked by AI. It's not about watch the videos and we hope you figure it out. We're looking at real data, tracking milestones along the way, and feedback loops on your one-on-one coaching, on the daily live streams in the markets, on the video library that you should be watching, which areas you need to refresh. This is a full ecosystem designed towards your success. Now, of course, we are doing a lot of things inside the community. Twice a day, we go live stream. We're doing one-on-one coaching. We're doing multiple times a week Q&A sessions, journal review, hot seats. There are so many things going on inside of the vibrant community, but it has to be upon application only. Reason being, there's only so many hours in the day. We cannot help thousands of people. So if you are interested in a step beyond what you see on this channel for a real personalized experience towards your trading, then make sure you apply in the link in the description, fill it out with all of the details. And if we are a good fit for each other, then hopefully I see you on a Zoom call very soon. And if not, and we don't decide to work together, I'm going to give you a lot of resources and goodies to make sure that we leave you better than we found you. Okay, let's jump back in. So moving on to this area, which is the neurological map. We are going to be doing a walkthrough of the brain. We have a 3D model over here. Again, if you download this, you'll be able to actually do a full inspection yourself. So as we walk through all of this, we have to realize there is a history of each part of the brain. And more importantly, each part of the brain has a response. So walking through, we have the rational architecture. So as we mentioned earlier, there's two main portions of the brain. One is going to be based on fight or flight, emotional responses. The other one is going to be the override of logic. So as we mentioned earlier, the prefrontal cortex is the slowest and youngest part of the brain, which writes your trading plan. Therefore, this is the type 1 because it's slow, it's decision making, it's using rationale, but most importantly, under emotional duress, this is the area of the brain that gets overridden by all of these other emotions. So the amygdala also is something we mentioned last time, is this portion of the brain over here. If you're curious, you want to play around with this, you can actually do different types of cross sections and cuts. You can zoom in and out and have a full exploration of what each section of the brain will look like. But we can see that this portion, the amygdala, is responsible for fear, anger, and revenge. The evolutionary threat response system fires within milliseconds, 6 times faster than your conscious thoughts, which was over here. So we can see it's a losing battle, which is why a fight or flight response is almost like a subconscious response. For example, when you touch something very hot, it's not like you think, ouch, this is hot, and then you slowly decide to move your hand away. It's an automatic reflex. And when you have a reflex, the parts of your brain that fire are faster, and the neurological pathway to your hand or your finger to move it away is actually skipping certain steps when it would be manually done. So we can see this portion can also fire up when you are facing emotions in the markets. The market is going to be an amplifier of fear, anger, and revenge. And therefore, if we see that this is a very fast, innate response deep within our brain, it takes a lot of strength, mentally, awareness, and a protocol in place to try and harness and control it. Next, we have the dopamine engine over here, the nucleus. This part of the brain, as we mentioned, is our reward system. It's very closely tied towards motivation and in achievement. Now, I'm going to show you this over here, which is the dopamine anticipation loop. Why greed never feels satisfied is because your relationship with dopamine. Remember, dopamine is related to greed, excitement, and even ego. Now, ego is a misunderstood word. I'm going to spend a lot of time on this topic because ego can be defined as narcissistic, overzealous, arrogant, and it can be seen as a negative trait. But at the same time, ego, on the flip side, can be something that is self-worth, self-preservation, that I deserve more, that I'm working hard to achieve something. So ego can be balanced out to something that is actually quite healthy. But if left unchained and unchecked, this can actually get out of control, leading to bad behaviors stemming from the same areas as greed and excitement. So what we have over here is the anticipation loop. So this graph showcases that dopamine does not peak when you get the reward. You're not getting dopamine at its peak release upon achieving a winning trade, upon actually getting the money that you desired from the markets. It actually peaks in anticipation of the reward, meaning thinking you're about to get it, thinking you could win a trade, thinking your winning trade could go further and you get greedy. You don't take profit when you're supposed to. In the predefined plan that was designed by the prefrontal cortex, remember, this is the youngest part of the brain that is responsible for decision making. This can be very easily overridden by our animalistic portion of the brain, the dopamine engine. Therefore, greed can very easily overpower logic. And that's happening when you are correlating it with dopamine. Because now the peak dopamine response you will have is when you think what you could do. Anticipation of profit will release more dopamine than actually achieving the profit. So then we have to understand greed, excitement, and every just one more trade decision is peaking over here before you actually get the reward of that winning trade. So you are fighting a neurological response of neurotransmitters flooding your brain that you have to manually override using your prefrontal cortex logic to make sure you don't deviate away from the plan and be emotionally driven to take emotional trades or emotional decisions. The next one is going to be what we call the gut feeling. Now, the gut feeling, again, is a very controversial topic because some people say your gut feeling is something you should not listen. And when I spoke to Jared Tendler, remember at the beginning, we have a lot of authors that we spoke about. Robbie Burns, I just did an episode with. He's the author of The Naked Trader. Jared Tendler, he's another author of The Mental Game of Trading. Did a wonderful podcast with him as well. With Jared Tendler, I tried to understand this topic very deeply, which was, what exactly is a gut feeling and should we listen to it? Because the gut feeling, what is it? In my opinion, initially, and many others, we say that our gut feeling is something that we should listen to. It's powerful. It's our subconscious brain. It's the parts of our brain that is not conscious, that we are noticing things on a subconscious level, and it's amalgamated together, which is why you say sleep on it, because your subconscious brain marinates with your conscious brain to give you a conclusion. So I thought it was a sixth sense, superpower, something to listen to. And then as I spoke to Jared Tendler and many other professional traders, they said you should not listen to your intuition. You should not listen to your gut feeling Because what it really is something that you haven't fully understood yet. Maybe it's a pattern you've recognized, but that pattern could be on a small sample size. It could be hijacked by all of these emotions where you skew and have biases, confirmational bias, survivorship bias. And so therefore, if it is in your subconscious and you haven't brought it up to the surface, you haven't fully understood it, tested it, diagnosed it, then why should you listen to it? And when I spoke to Samir Varma, he said specifically that even if you have a gut feeling and it's very loud, the arena to test it out is not in the live markets when you are trading. Maybe you can test it out in backtesting, run simulations, and then later decide, but you can never act upon your subconscious or gut feeling because it's not something that is powerful if it's not fully understood. And the arena to test it is not in the live markets. However, most retail traders, most novice traders, we always act on our impulses. We always act on how we feel. And for example, if we take 4 losses in a row, our gut feeling will always be negative. If we have 5 winning trades in a row, our feelings will always be positive. So we can see how very easily our gut feeling can be influenced by all the types of biases that exist. And of course, a big one of them is going to be a gambler's fallacy. The gambler's fallacy is all tied into dopamine and tied into gut feeling, intuition. This is all going to be signaling the idea that this trade feels right or this trade feels wrong. So this is where we get into fear when you avoid trades that you should be taking, or stubbornness to take trades that you shouldn't be taking. Both of these emotions are going to be tied by this portion of the brain. So I'm going to encourage you to go through all of this in your own time. Again, download the resource. You'll be able to have a full exploration, cut it in different slices, and fully test it out, zoom in and zoom out, and really understand the biology behind your emotions. Now, the next emotion that I'm going to cover is fear. Now, fear, the lethality index over here, you can see is very high because greed and fear are the 2 emotions in the market that are felt with greatest intensity and have the most detrimental outcomes if you listen to these emotions. In fact, a lot of people just distill psychology. They eradicate all of these and say all bad decision making in the market is distilled down to either fear or greed. Now, I think all of these emotions have its place and they are really telling us something different, but a lot of people do agree that these are the big 2. So let's focus on this one next. So fear, what is it going to look like? It's going to look like I see the setup, I just cannot pull the trigger. Fear is an emotion that stops you executing what you already know, what you should execute upon. It just shows up as hesitation before entry or a premature exit from a winner trade because of the fear of reversal. Because a lot of traders, what they do is in a winning trade, they feel fear, and in a losing trade, they feel optimism because in that losing trade, when it's in drawdown, they are optimistic that it's going to turn against us. They move their stop losses further away but to allow the trade to play out. But in a winning trade, what we're going to do is we're going to be less optimistic and more pessimistic. We're going to be feeling the emotion that price may reverse on us. This winning trade may turn into a loser, and then we don't give it time to play out. We try and cut it short. So how can it be during a running trade if we are in drawdown that we are going to be optimistic and allow it to play out? But when we are actually in floating profits, we are going to cut it short and be pessimistic. Different emotions just by small changes in price action. And in fact, one of my podcast episodes, I spoke to Fabio Valentini, who is a World Cup trading champion. He's a hyper scalper. And he was wearing a Whoop band, a tracker for your biomarkers. So I asked him, have you ever studied what your Whoop metrics look like during a trading session? And he actually very interestingly shared with us that the highest stress point or the highest level of fear is not during a losing trade or when you're in drawdown. It's actually heightened in a winning trade when you're floating in profits. And the reason for that is when you are entering drawdown, your loss is fixed. If you risked $1,000 on a trade, you know that as you approach your stop loss, your loss is going to be $1,000. It's never going to be more. However, during a winning trade, when you are floating profits, maybe you're floating a 1 to 3 risk to reward. Now with that $1,000 risk, you are floating $3,000 in profits. And let's say your target is $4,000. So therefore, if that trade reverses on you, it's $3,000 of opportunity cost, of money left on the table. Not a loss, but it's a loss of potential earnings. So therefore, a loss can only be felt of $1,000. But a winning trade reversing on you could be felt of $3,000, or if it doesn't break even, it goes actually to a loss $4,000. So that's why these emotions are heightened during a winning trade, because the fear of that trade reversing on us in dollars is higher, which is why very often the feeling of fear acts as hesitation to enter the trade, but also fear to hold the trade towards its targets, especially when you're risking too much or you're trading these prop firm accounts when you're not used to the large numbers of these large accounts. Even though the percentages may be what you're used to, the dollar amount will play with your head and make you feel fear when you don't need to. Fear isn't just a feeling, it's a neuroendocrine state that actively degrades your decision-making machinery, and you're literally thinking without your brain. It's just an emotional response. This is something that even if you think you have things under control, you cannot overcome your biochemistry. So it's much better to have a protocol in place, which I share over here. This before, during, and after. Follow the protocol is going to have a much higher success rate than you feeling these emotions and trying to fight your evolution, trying to fight your brain, trying to fight biochemistry through logic, which is going to be suppressed. Sometimes you might get it right, but it's much easier to follow a plan than sit and meditate and journal and try and control and harness these emotions which are not designed to be controlled. It's better to have a protocol, a fail-safe system in place. Lastly is going to be the psychology. Where does this emotion develop from in our life? It is from attachment injuries and unsafe money. Traders who grew up in financially unstable homes or who experience early attachment injuries around loss of security, abandonment issues, and so forth, carry a nervous system wired to treat any financial setback as an existential threat. The fear is not only the trade, it's of what that trade represents, which is safety, self-worth, parental improvement, the relationship to love, as I mentioned earlier. This can all be felt during a losing trade, therefore a lot heightened compared to what that loss actually was in dollar amounts. Losses in these traders trigger a trauma response disproportionate to the actual dollar amount. So when we understand that these are the three root causes from our evolution, from the neurochemistry, and from physiological development, then we can see this is a deep-rooted emotion. These are the things that are going to amplify it. For example, recent large losses, oversized positions. If you're trading scared of money, for example, accounts much larger than you're used to, just like prop firms, which is why in backtesting you'll be great. Trading a small account, you'll be great. And the moment you buy an evaluation of a $100,000 account, even though it's demo money, even though it only costs you $500, losing small controlled trades of 1% risk will feel like you lost your livelihood, an intensified feeling because of the biochemistry behind it. So when I have the feeling of fear, I try to override these emotional responses of real life threat, that everything is doom and gloom, and I try and understand that this is a signal to me, and my body is signaling to me through this feeling of fear that this position size is bigger than my nervous system can handle. Therefore, what is the correct response to do? It can be, for example, position down. It can be, for example, trade a demo account at this account size so that you get used to these numbers. There's a lot of protocols you can have in place that I've listed over here that is going to calm your nervous system, that is going to acclimatize towards that feeling of fear, acclimatize towards the number. I call it immersion therapy. The more you expose yourself to a stimulus, the more you immerse yourself in that feeling, the less likely you are to respond randomly towards it because you're getting exposed to it and used to it. Fear is almost always a size problem masquerading as a psychological problem. If a setup matches your criteria and you still can't pull the trigger, it's rarely the setup that is the issue. It's the dollar amount attached to it, because we can all paper trade it in backtesting when there's nothing at stake. Because the dollar amount exceeds your current emotional bandwidth. The signal is size down until the fear disappears. Trade the size at which you can follow the rules cleanly and then build up your emotional state to match the dollar amounts you should be trading. It's an exposure therapy, not a logic therapy. You don't journal your way out of it. You don't logic your way out of it. You expose yourself to it multiple times to when you realize that this fear is irrational and it subsides. So of course, for me to walk through all 8 emotions is going to take a lot of time. So I'm going to do a part 2, but what I want to do is give you something to take away for today. And number 1 is going to be the synthesis. How do we connect all of these emotions, all 8 emotions, 2 of which I've covered, the rest I'll cover next time. And what do we conclude from it? 6 patterns under all 8 emotions. These are the patterns that can be condensed down out of all 8 emotions. Look at all 8 emotions side by side and something becomes obvious. They're not really 8 different problems. They are 8 different expressions of the same handful of underlying patterns. Understanding these patterns lets you build a trading practice that addresses the root and not the symptoms. These 6 operate under everything that we've discussed. So number 1 is the reframe. Emotions aren't noise, they are misapplied signals. You need to better understand what the emotion is signaling to us and have a protocol in place, because every emotion in this document is an evolutionary trait to solve a real problem. Avoid predators, seek calories, or defend status, or close social debts. The emotion is not broken, humans are not broken, it's simply the context. The work isn't to suppress the signal, it's to better understand the signal and the behavior we should associate to it. Next is going to be identity fusion is the common breakpoint. Greed, ego, stubbornness, revenge, desperation. 5 of the 8 collapse when the trader's self-concept separates from the P&L. You are not your last trade. You are not your account, so it's an identity. The next is going to be the prefrontal cortex goes first under pressure. Understanding that your logical brain disappears, downregulates when other neurochemicals are amplified during the markets and emotions. Every one of these emotions intensifies in proportion to how offline your rational brain is. Sleep, nutrition, cortisol management, physical regulation. These are not wellness criteria. These are infrastructure for your decision making. So therefore, the general environment, how you control everything around you, what you do outside of the market affects what you do in the market. A well-regulated nervous system is a trading edge. An exhausted one, or with chaos around you, with your relationships, with your friends, with the financial situation you're in, if all of these are out of sync, of course, it's going to affect your emotions, which is going to affect your performance. So therefore, controlling the controllables in your environment is also going to act as an edge. Next is going to be rules must be pre-committed, not decided live, because you cannot make sound decisions in the moment when your active brain, your prefrontal cortex is downregulated. Therefore, having protocols like I'm sharing in this document and memorizing and committed towards them is going to lead to better decision making in a heightened state. Next is going to be position size regulates every emotion. So therefore your relationship towards risk and reward and all of these factors as we mentioned. Exposure therapy, immersion therapy, correct lot size is all going to be your friend in this scenario. Towards the point when these emotions are amplified, when you're taking risk that you should be taking, when you've acclimatized towards it, you'll be better prepared to manage that. And lastly, structure solves what willpower can't. Every protocol in this document leans on a structural constraint, hard stops, platform enforced limits, mandatory cool-offs. Everything in the protocols that I'm showing over here are designed to be your friend. Memorize all of them. With each emotion, there is a protocol. Learn the protocols, and therefore you'll be in a better position. You don't solve these emotions, you architect a trading practice in which their expression is structurally blocked. And therefore, the quick protocol you can do, a checklist to follow from tomorrow's trading session is number 1, name the emotion before you act on it. Number 2 is size the primary emotional lever. Number 3 is stop hits are the system working. Number 4, your thesis and your trade are separate, which is why I always say there's a difference between a trade idea and a trade execution. What I think the market can do, reading the market versus trading the market are separate things. Next is going to be a winning streak is a sample, not a step change. Next is going to be understanding that loss are tuition. You can't refund them. Understand them as a lesson. Next is going to be boredom is not a signal. You can make a lot of decisions that are wrong based on boredom. Trading can't rescue a broken life structure. Pre-commit to decisions, don't live decide. And lastly, structure beats willpower every time, which is why I always say, I'm going to get into it in a second, your edge isn't only in the charts, it's in the space between your impulse and your action, which is why I always say a restricted trader is a profitable trader, both in your technicals and your psychology.